Tesla had stock rallies for 3 Decembers in a row from 2023 to 2025. But this year, Tesla might not run the same script again. The stock is down 10% this year, while Nasdaq is up 16%. And people are waiting for the usual year-end jump. But I checked why each of those Decembers actually happened. It was never the season. It was 3 different reasons, one for each year. And in 2026, all 3 are gone. So before you buy this dip, be careful. In this video, I will show you the exact numbers that decide whether Tesla could rally again in the second half of 2026. And no, it is not just about Robotaxi and FSD. It is more complicated than that. 2023 was a rebound. Tesla had crashed 65% in 2022. So it started from a deep low. It cut car prices hard to sell more and deliveries jumped 38%. Then in December, the Fed signals interest rate cuts were coming in 2024 and the whole market ran into year-end. Tesla more than doubled on the year. 2024 was politics. The move came in November. Donald Trump won the election on November 5, 2024. Elon had backed him and the money poured into what could mean for Tesla. By December 17, 2024, the stock closed at $479.86. 2025 was a story. The Robotaxi and self-driving story took over. The market stopped counting cars and started paying for the future. On December 16, 2025, Tesla closed at an all-time high, $489.88. A rebound, an election, a story. Not one of them was the month. You were counting on a season that was never really there. And there is a warning in market history here. For most of the 20th century, stocks jumped every January. From 1904 to the 1970s, the market returned about 3.5% in January against 0.5% in the normal month. Then in 1976, a study put it in print. Everyone learned it, and by around the year 2000, the January effect had mostly faded. Once a pattern gets that well known, people buy ahead of it and it stops paying. So the date was never the reason. A catalyst was, which means 2026 needs its own catalyst. And that is the first question. For years, one thing helped Tesla near the end of the year. A $7,500 government discount for buying an electric car. That discount ended on September 30th, 2025. Now look at the timing. A deadline like that makes buyer act early. So the rush came before the deadline in the third quarter of 2025. After that, Elon himself warned of a few rough quarters. On the July 2025 earnings call, it named the end of 2025 and the start of 2026. So what actually happened? The opposite of the warning. The quarter that ended in June 2026 was a record. Tesla delivered 480,126 cars, up 25% from a year before. The demand crash people feared did not show up. The record is real. The question is what is holding it up. 3 things held it up, and this is where it gets interesting. 1. Tesla launched cheaper cars. The Model Y Standard came in $5,000 slower at $41,630. Cheaper cars sell more, but Tesla earns less profit on each one. 2. China. Tesla's wholesale number there rose 24% in June. But look closer. Its actual retail sales inside China fell almost 14% that same month. The strong number came from exports, not from Chinese buyers. 3. Gas prices. When gas is expensive, more people switch to electric. And gas was expensive because a war shut the streets down from February 28, 2026. This directly helped the EV sales in Q2. Now here is the forward part. 2 of those 3 are already turning. The strait reopened in late June 2026. Oil prices are falling again, and Morgan Stanley is warning of a glut, which means too much supply. Cheaper gas is coming, and cheaper gas makes an electric car a little less urgent. And the extra sales came from cheaper cars, which pulls down how much Tesla earns on each one. So the car side for the second half is genuinely mixed. Strong sales, weaker support behind them. And that is exactly why the market has stopped trading Tesla on the car number at all. Look at July 2nd, 2026. Tesla reported that record quarter. It beat Wall Street by 74,000 cars, and the stock fell 7.49% the same day, its worst day in almost a year. So the car number is not what sets the price. At about $1.2 trillion, Tesla trades near 200 times its expected profit. That is not a car company price. It is betting on self-driving. So the question for the second half is simple. Does that bet move forward or stall? 3 signals. First, the fleet. Tesla's Robotaxi is live in 5 cities now: Austin, the Bay Area, Dallas, Houston, and Miami, which opened on July 3rd, 2026. Miami is the one to notice. It launched with no safety monitor in the car from day one, the first city outside Texas to do that. The Bay Area is the opposite. California only allows it with a safety monitor in the seat. But the fleet actually carrying paying riders is tiny, about 20 cars. Elon once aimed for 1,000. And by mid-June 2026, that count was not growing. In Austin, it dropped from 19 cars to 14. The Cybercab, the car built only for this, is not carrying a paying rider yet. Tesla put the first ones on public roads on June 30th, 2026 doing test laps. The story shows a map of cities. The record shows about 20 cars. Here is my take. That gap between the map and the cars actually on the road is the gap in the stock price. If Tesla floods that whole map with cybercabs carrying paying riders, the price follows them up. That is the bet. Second, approvals. This is the catalyst that would actually move the stock, and it is stuck in the same place on 2 continents. In China, Tesla switched on a limited version of its self-driving on May 21st, 2026. But it still cannot turn it on for every car. Full approval sits with Chinese regulators, and Tesla is targeting the 3rd quarter. In Europe, the approvals look like a wave, but every one of them leans on a single approval the Netherlands granted on April 10, 2026. Here is why that one approval matters so much. In Europe, a car does not get approved 27 times, once for each country. It gets approved once by one country, and that counts across the whole EU. Think of it like a driving license. One country issues it, and every other country lets you drive on it. You do not retake the test at every border. Tesla runs its approval through the Netherlands. So when the Dutch said yes on April 10, 2026, the other countries did not test the software themselves. They just accepted the Dutch decision. Lithuania and Estonia took it as it was. Denmark read the file first, then agreed. But it is all one approval, the Dutch one. And that is the risk. If that one approval breaks, they all break. The Dutch approval is still only temporary. To make it permanent, the whole EU has to vote yes. That vote needs 55% of the countries and 65% of the people, which really means Germany, France, or Italy have to agree. And so far, none of them have. They are not the only ones holding back. Officials in Sweden and Finland have asked why Tesla's system is even allowed to drive over the speed limit. So if the EU votes no, the Dutch approval is cancelled, and every country that accepted it loses it at the same time. The entire European rollout depends on one approval that one committee can still reject. There was a company that had everything Tesla is chasing here. Full approval, paying riders, cars running across several cities. Then it was shut down, almost overnight, and it was gone. I told that story, and the one number Tesla still hides in another video. link in the description. Third, safety, and this is the one that can freeze everything. In June 2026, in Katy, Texas, a Tesla Model 3 left a residential road at 73 miles an hour and hit a house, killing a 76-year-old woman inside. The driver blamed Tesla's self-driving. Tesla pushed back hard. It says the driver took over, hit the accelerator himself, and that is software obeys the speed limit and would never do that. My opinion is this. It looks like it could be the driver's mistake, not the software. But here is why it still matters. And this is the part people miss. Even if Tesla is completely right, a death like this forces regulators to slow down. Because if they approve self-driving and someone dies, they own that call, so they tend to wait. Tesla is already under a US investigation covering about 3.2 million cars. And remember those European regulators worried about the speeding. That is exactly the headline that makes them wait longer. And it is not only Tesla. On July 5, 2026, a group of Waymo cars got stuck in San Francisco traffic until their batteries died and had to be towed. The whole business is still young. Safety does not just risk the story, it slows the one catalyst that could move the stock. So if you are holding Tesla and thinking about adding more before December, be clear on what you are actually buying. Not 480,000 cars a quarter. You are paying close to 200 times earnings for a self-driving future that today is about 20 cars, approvals you do not control, and one open safety investigation. So those are the three things that actually set this price now. The fleet, the approvals, the safety probe. Which one are you watching most? Tell me below. And if this is holding up so far, give it a like so it reaches the next person trying to make this same call. So which number do I watch first? It is not the deliveries, it is margin. And you get that read on July 22nd, 2026, the next earnings call. Deliveries only tell you how many cars moved. Margin tells you how much Tesla earns on each one. The last clean number we have on the cars alone, not counting the credits Tesla sells to other car makers, its margin was 19.2% last quarter. The fear is that cheaper cars drag it down. And here is where the big firms openly disagree. Barclays analyst Dan Levy raised the stock a hold with a price target of $360. He warns that rising input costs, memory chips and copper are squeezing that margin. Redbush's Dan Ives rates it a buy with a price target of $600. He argues self-driving adoption is climbing past 50%, which reshapes those margins upward, and that the car margin worry misses the point. $600 against $360. Same company, same quarter, almost double. That gap is the whole argument in one number. And the near-term risk is real. If Tesla clears its extra cars with price cuts, that alone could erase $400 to $600 million in profit this quarter. So July 22nd is the test. I had held Tesla for 6 years. I'm not selling. And for the last few years, near the end of the year, I bought call options. That is a bet the stock goes up by a set date. I made huge profit doing it 3 years in a row. But this year, I'm not sure I will do the same. And the reason I'm not sure is the reason I made this video. Here are the 3 things to watch for the rest of 2026. 1. July 22nd, the earnings call. Watch the margin, not the number of cars. 2. China. Watch for full self-driving approval. Elon says the 3rd quarter. If it slips, the biggest reason to run slips with it. 3. The real Robotaxi count, not the map of cities. The number of cars actually carrying paying riders, and the finding from the Texas crash investigation. December never moved this stock. A rebound, an election, and a story did. And this year, those reasons belong to regulators and the price of oil, not to Tesla. The one number that decides Tesla's self-driving future is the one Tesla still refuses to publish. I went 3 layers deep on exactly that number in another video, so click here to watch it now.